Hey, if your company is selling digital services around the world, there's a really specific tax rule in Turkey you absolutely need to have on your radar. We're talking about value added tax, or VAT, for foreign companies. And believe me, it's one of those details that can cause huge problems if you overlook it. So let's break it all down. So let me ask you this. Is your business model built around things like software as a service, video streaming, or maybe online courses? And are you selling those directly to customers in Turkey? If you are, well, you might be sitting on a pretty significant and maybe totally hidden tax liability. So what is your core responsibility here? Let's dive right into the fundamental rule for doing business in Turkey, even if you're operating from, halfway across the globe. Okay, here's the rule, plain and simple. If you are selling any kind of electronic service directly to individual consumers in Turkey, you are required to register for, collect, and pay their VAT. And the crucial part? This applies even if you have no office, no employees, absolutely zero physical presence in the country. None. Now, this is probably the most important distinction you need to make. Are you selling to everyday consumers, or are you selling to other businesses? We call that B2C versus B2B. For B2C, the responsibility is 100% on you. You've got to register, you've got to file a specific VAT return. But for B2B, it's different. The Turkish business you're selling to handles the VAT through something called a reverse charge mechanism. Basically, they pay the tax for you. For today, we're focusing on B2C, where the ball is entirely in your court. So this obviously leads to a really important question. Does this rule actually apply to your specific business? Let's take a look. The scope here is, honestly, incredibly broad. We're talking about the very heart of the modern digital economy. SaaS platforms, cloud apps, streaming services for music or video, online education platforms, even digital advertising. If your business is in any of these spaces and you have customers in Turkey, it's almost certain this rule affects you. All right, so we've covered the what. Now let's get into the why. Because ignoring this isn't just a little compliance issue, it is a major financial risk. It's pretty easy to think that because you're a foreign company, you're somehow invisible to local tax authorities. But that is a really dangerous assumption to make. The Turkish Revenue Administration is actively, and I mean actively, monitoring these transactions, especially the payments that are flowing through Turkish banks. They are definitely watching. So what happens if they find you're not compliant? Well, first you'll get hit with what's called the tax loss penalty. This is a fine that's anywhere from 50 to 100% of the unpaid VAT you owe. Just think about that for a second. That could instantly double your tax bill right there. But it doesn't stop there. On top of all the unpaid VAT and that massive penalty, they're going to add late payment interest. And get this, it's at a rate of roughly 3% per month. That's not per year, that's every single month. You can see how this can spiral into a huge financial nightmare really fast. And the problems just keep piling up. The authorities can go back in time and assess taxes on all your past sales. They can add extra fines for not filing your returns correctly or at all. This can easily trigger a full-blown tax audit. And on top of all that, they can actually make it difficult for you to even get paid by your Turkish customers. It's a huge operational headache. And if you're wondering just how seriously you should take all this, just look at who's already complying. We're talking about the biggest global players out there. Netflix, Google, Meta, they are all following these rules. Why? Because Turkish authorities have made it a top priority to tighten enforcement on exactly these kinds of companies. Okay, I know that was a lot of scary news. But here's the good news. There is a clear path to getting compliant. It's a straightforward roadmap, not some impossible maze. The whole process really boils down to these 4 steps. First, you apply online. Second, you get approved and they give you an official tax number. Third, you file your tax returns electronically. And fourth, you make the payments. It's a structured step-by-step system. And here's a really key detail that makes this whole thing much easier. You do not need to set up a local company. You don't need a physical office in Turkey. The entire system was actually designed specifically for non-resident companies just like yours. So that brings us to our final section. What's the smart way to move forward with all this and make sure your business is protected? Let's be honest, navigating a foreign tax system is complicated, which is why a lot of businesses decide to get expert help. Professionals can help you figure out your exact obligations, make sure the registration is handled perfectly, manage all your ongoing filings, and even look back to assess your risk from past sales.
It's really all about de-risking the entire process. And so, this brings us to the final and most crucial question. After seeing the rules, the risks, and the clear path to get things right, you really just have to ask yourself, is my business protected? Or right now, is it exposed? Honestly, the answer to that question could define your success in the Turkish market.